Welcome back to this edition of the Vantage Report. I'm Hazzi, and today we're going to take a deep dive into the ever-evolving real estate landscape, unpacking the latest trends and what they mean to you. So let's begin with a broad overview. Property sales have experienced a significant downturn, falling by over 30%. If you recall, during the spring we had a nice little active market going with 600 to 700 sales each month. Well, recent months we've witnessed a slowdown to just about 300 deals, and actually less than that last month. And this is a decline that's been mirrored across the entire Canadian landscape. If you zoom in on Vancouver, sales figures are now trailing 25% below the 20-year norm. The expiration of rate holds last month may have played a role, with many of the previous approvals anchored to a 5% rate that you can no longer get. An area of interest has been the luxury sector. Homes with price tags over $2 and $3 million have actually seen their sales sliced in half. If you think back to this time last year, this very segment showed remarkable resilience against market fluctuations. Now this shift prompts several questions. Is this a temporary dip or a sign of changing buyer priorities? Are external economic factors playing a larger role in influencing the high-end purchase? On the inventory side, we've observed a 2% rise since our August report, but the significant point to note here is that overall inventory is now extended beyond 10 months. This isn't predominantly due to a surge in listings, but a tapering off or a falling off a cliff of demand. Breaking down the inventory, condos and townhomes remain stable at 6 months inventory, but the surge in single-family home inventory to north of 10 months definitely needs more attention. This disparity may guide buyers and investors on where potential opportunities or oversupply exists. In terms of market time, properties now spend an average of 54 days listed before being sold, and the discount rate is still around 3%. Although both of these stats are marginally weaker than the previous months, and we are just now heading into our slower season. Shifting focus to property prices, single-family homes have seen a 5.8% dip recently, with townhomes, although more resilient, not far behind at a 3% decline. Yet it's the condo market that's taken a significant hit with a nearly 10% drop. This steep fall in the condo segment is kind of intriguing. One theory I have is that the financial equation of owning versus renting a condo might be influencing buyer decisions. If you consider the cost of ownership of a $500,000 condo is nearly double what that same condo could be rented for today. Now that's not to suggest that buying a condo in today's market is a bad move, as there are some great opportunities and creative ways to navigate the monthly expenses. It's just that these are not widely understood, so as a consequence, the condo market has taken a hit. Here's an interesting stat. The current average transaction stands at right around $800,000. Now to manage this, a buyer's income would require that they be in the ballpark of $150,000 per year. That would put that buyer in the 95th percentile of income earners. This stark reality underscores the prevailing affordability challenges that many face. The biggest market influencer right now is most certainly interest rates, and although the Bank of Canada looks to have paused their rate hiking campaign, it does appear that the bond market is doing the dirty work for them. Sustained high interest rates, waning consumer confidence and business confidence, as well as a GDP contraction for 4 straight quarters when you adjust for population growth, have all played a part in this market contraction that we're now experiencing. Given these complexities, what's our takeaway? For prospective buyers, understanding the current market intricacies is paramount. Even if perfect timing remains elusive, there are surely to be some great opportunities in the coming months. I saw a great meme the other day that hit the nail on the head. $30,000 off at 6% interest is a way better deal than $100,000 over list at 3% interest. Now for sellers, in a market that's soon to be crowded with options, making your property stand out in terms of presentation and competitive pricing is more vital than ever. If you plan to buy again when your property sells, remember it's all relative. The home you're going to buy next will be coming down too. Now this works especially well for move-up buyers, as I've explained in previous videos. For downsizers and people cashing out, try and remember this: having cash in the till as we go into what will be one of the most exciting periods for investors in our lifetime will set you up for life. Make sure you factor in the opportunity cost of not selling and missing out. Heck, even a short-term GIC is paying over 5% yield right now, so cash is truly king as we enter this next phase. Another exercise I like to go through with homeowners is this. Let's say the average person who's selling right now or thinking about selling bought their home 7 years ago. In 2016, the average house was about $500,000. Now let's say you just carried it for a few years, and by 2019 you were excited to see that your values had exceeded $700,000. Fast forward a couple years more and you're into 2021 and you've seen the values have increased over $900,000. And yes, of course, we went through that pandemic period where things overheated and we had that blow off top. And yes, for a moment, your property was worth $1.1 million. But had you sold and bought again, you would have likely had to pay over $100,000 over list for a property that you only kind of liked and had to forego your home inspection. So not necessarily the best thing. So try to remember the feeling you were having when you saw your property values at $900,000 or $950,000 2 or 3 years ago. That's where we are today, which is still amazing when you zoom out. And the best part is you get to buy again in a normal market with plenty of choice. The only downside, of course, is that the rates are silly high at the moment, but we do expect them to come down in the next 6 to 12 months. Thanks so much for watching, guys. I hope you found this tremendously helpful. As always, my goal is to be your eyes and ears on the market. If you're interested to see what your home could fetch in today's market, you can start that process right here on the blog with our handy home valuation tool. And if you're interested in poking around to see what properties are available in today's market, you can start that process right here on the blog. Thanks again for watching. I'll see you in a couple months.